Hi, welcome to Ask Tim, the insurance technical podcast brought to you by IABNY. I'm your host Tim Dodge, and I'm coming to you today from the Geek Cave, deep within the basement, subfloor, subatomic level here at IABNY headquarters. It's a veritable nerve center with cutting-edge technology. I even got a cell phone. Now, here at the Geek Cave, there's nothing we like better on a sunny summer afternoon than to curl up with some beach reading. I'm just perusing a little section here on the duty to defend standard in the commercial general liability policy, but that's not really what you're tuning in to hear about. So, let's move on. Okay, as you can tell, my aim's a little bit off, so I'm going to be squeezing the stress ball to kind of loosen up a little bit while I talk. Anyway. Today's topic is a bill that recently passed the New York State Legislature having to do with modernization of commercial lines regulation here in New York State. This is Senate Bill S. 5811. And the purpose of this bill is to enable carriers writing within New York State, admitted carriers writing within New York State, to compete more effectively with their peers in the London and out-of-state markets. The idea being is that we want to drive as much insurance business to the state of New York as possible. So this is an idea, this is a priority that's really been around the New York Insurance Department for a few years, dating back to when Eric Dinallo was superintendent. And it's a bill that we have been working with the legislature to enact into law for some time now. As I record this, both houses of the legislature have passed the bill, and we expect Governor Cuomo to sign it. So what this bill does, it adds to New York's special risk law, commonly known as the free trade zone. And under the free trade zone, as some of you may know, admitted carriers can write policies without filing the rates or forms for certain classes of business if they meet certain premium thresholds or if they fall into certain classifications. This law, the Commercialized Modernization Law, builds on that by adding in new types of organizations for which insurance companies can sell policies where they don't have to file the rates or the forms. Now, the technical term in the law for these types of organizations is large commercial insureds, and there is a detailed definition of what exactly is a large commercial insured. In concept, that is supposed to be an organization that has some sophistication in buying insurance coverage. So, as opposed to a small pizza shop or a video store or a small manufacturer who really know their business really well, but aren't that well versed in insurance coverages or in buying insurance, those types of risks would not be eligible. They're not, not to put them down, but they're not sophisticated insurance buyers. The large commercial insurers are supposed to be a little more sophisticated and therefore may not need the benefits of regulators' approval of rates and forms the way some of these smaller accounts and personal insurance buyers do. So a large commercial insured is one that generates an annual commercial risk insurance premium of more than $25,000. And I know on the surface $25,000 doesn't sound like a whole lot, but in addition to that threshold, the risk has to meet at least one of the following 7 criteria. Now, they can meet more than one, but they have to meet at least one of them. Number 1, net worth of at least $7.5 million. So assets minus liabilities, at least $7.5 million. Number 2, gross assets greater than $10 million and net worth of at least $1.5 million. Okay, so if they don't have a net worth of $7.5 million, as long as they're at least $1.5 million and have assets greater than $10 million, then they qualify. Number 3, a for-profit business with annual gross revenue greater than $15 million and a net worth of at least $1.5 million. Or a for-profit business with gross assets greater than $10 million and annual gross revenues greater than $15 million. Or it can be a not-for-profit or public entity with an annual budget of at least $20 million. Or it can be a municipality with a population greater than 50,000 people. Or lastly, the risk has to have at least 50 employees or at least 100 employees within the corporate structure. So it could be a subsidiary of another company, but as long as the corporate structure has at least 100 employees, then they would qualify. So the large commercial insured has to generate commercial risk insurance premium of at least $25,000 and meet one of those 7 criteria. In addition, the insured has to retain or employ a special risk manager. Now, a special risk manager has to be a licensed insurance producer, but that producer cannot be employed by the insurer who's providing the coverage to the large commercial insured. The special risk manager is someone who provides skilled services in loss prevention and reduction, or risk and insurance coverage analysis, and the purchase of insurance. In addition, they have to satisfy certain educational and experience requirements, things like maybe having a CPCU or having performed these sorts of tasks in the insurance industry for a certain number of years. Those requirements are spelled out in the language in the legislation. I'll have a link to the bill itself in the show notes. Now, even though carriers are free from rate and form filings here, they still have to make informational filings with the insurance department. So even though the insurance department, or the Department of Financial Services, as they will soon be known, they don't have rate and form approval authority here, they still have to be kept informed as to what's going on. The policies have to contain notices informing the insured that the rates and forms are not subject to regulatory approval, very much like what you see on free trade zone policies now. And lastly, the Superintendent of Financial Services still retains the right and the authority to require rate and form filings if he or she determines that that's in the best interest of the policyholder. So even for these sophisticated large commercial insurers, there is an element of consumer protection in there, so that they are protected if there's something in a policy form or a rate being charged that is grossly unfair. The superintendent still has the power to require prior approval. Lastly, this law expires. It's only temporary. It can be extended. The legislature has a history of extending temporary laws, but it's going to expire on June 30th, 2013. So the legislature and the Department of Financial Services will monitor how this is working over the next couple of years, and then they'll make a determination as to whether it's something that should be continued or whether it should expire. We're going to have more information on this in the show notes that you'll find on the blog that accompanies this podcast. Also, take a look at the June 30th, 2011 issue of the Capitol Report, where you'll find a very detailed analysis of this bill. If you need to contact me, as always, you can email me at tdodge@iabney.org. You can call me at 800-851-8853, extension 229. Reach me by fax at 888-432-0510. You can find me on Twitter as Ask Tim. You can find me on AOL Instant Messenger as TDog4494. And you can always leave a comment, and I love to receive comments, by the way, on the blog that accompanies this podcast, which you can find at http://insurancegeek.typepad.com. That's it for this episode of Ask Tim. We'll be back with another episode in the near future. And in the meantime, if you need advice on how to de-stress by squeezing a stress ball, just don't forget to ask Tim.